Increase the liquidity, safety, rate of return, and tax benefits on money. By the end of this video episode, you will understand why a MEC can be superior to money just deposited in a bank or credit union. So I'm Doug Andrew. I've been helping people optimize financial assets and minimize taxes now for nearly 5 decades. And if you've watched very many of my educational videos, episodes, and maybe read one of my books, you'll realize that one of my favorite financial instruments to accumulate money tax-free and then be able to turn on tax-free income during retirement or even earlier than retirement if you want. But also when you ultimately pass away, my favorite vehicle blossoms. It increases in value and transfers income tax-free. So let me give you a little example. It's what I call a laser fund. LASER is an acronym that stands for Liquid Asset Safely Earning Returns. What is a laser fund? It's a properly structured, maximum funded, indexed universal life insurance policy where you design it primarily for living benefits more than the death benefit. This was the brainchild of E.F. Hutton clear back in 1980. And I have actually averaged 9.62% rates of return for the last 4+ decades with my money in max-funded universal life policies. And after 1997, indexed universal life was introduced, where you can participate when the market is going up, but not lose when the market goes down, because your money in an indexed universal life is actually not invested in the market. It is safely tucked in the insurance company, earning the general account portfolio rate that they earn on their portfolio of AAA and AA bonds and maybe mortgages on skyscrapers and shopping malls and what have you. And so you can settle anytime you want for the general account portfolio rate the insurance company is earning on their billions or even trillions of assets, which might be 4 or 5%. But anytime you want, you can tell the insurance company to keep your money safe. But that year, if you want, they can take the interest on your money. Let's say it's 4%. And let's say you have $1 million in that IUL policy at this point in time. 4% of $1 million would be $40,000 of interest. You could just say, just pay me that. But if you feel bullish about America, you're telling the insurance company, take the $40,000, the 4% interest you're earning on my $1 million, and you don't have to add it to my account this year. You can use it to have the wherewithal to pay me whatever the index or indices that I choose. And so if we use, let's say, the S&P 500, even though you can diversify between several, like the Dow Jones or the Russell 2000 or whatever, the insurance company then takes the 40,000, 4% on $1 million in this example, and they buy upside options in the index that you chose, the S&P, so that they will have the wherewithal to pay you whatever that index increases by. If it increases that year by 8%, they'll pay you 8% on $1 million or 80,000, because 40,000 of options doubles to 80,000. Or maybe even 12%, 120,000. Sometimes they will cap you because of the price of options. You can only earn up to a cap of, let's say, 12%. But what's the advantage on the other end? If the market crashes and drops 40%, like in 2008, our clients who owned IUL in 2008 didn't lose one dime that year due to that market crash. They may not have made much of anything, but they didn't lose. And they started making money again the first 90 days of 2009. In fact, most of them locked in gains of 16% the first quarter of 2009 after not losing in 2008. If you had that $1 million in the S&P, in the market, that million would have gone down to maybe 600,000. Our clients still had their $1 million at the end of 2008. They simply gave up the 4% interest that year. Or that year, there was actually 5% interest, 50,000. But if the market goes up, they have the wherewithal to pay you whatever the S&P does or whatever index you chose up to a cap. Now, sometimes you have indices that have no caps, but they subtract a threshold, maybe 5 percentage points. And there's sometimes opportunities where you want to choose to do that, like March of 2020, when the COVID-19 pandemic caused the market to drop 30%. Many of our savvy advisors told their clients that had indexed universal life to link to a 1-year point-to-point with no cap. And they realized that they would have to subtract 5 percentage points off of whatever they earned. Well, from March of 2020 to March of 2021, the market went up 66.33%, minus 5%. They netted 61.33%. Yep. Many of them were able to lock in gains in March of 2021 of 61.33%. One client, they had about 850,000 in their IUL policy in March of 2020. 1 year later, and they didn't add a dime, that account was worth $1,387,000. They made over $535,000 or so by linking to a 1-year point-to-point with no cap. Subtract 5%. Okay, it's phenomenal. But let's talk about just the basics. People do this in a max-funded IUL policy, generally because they want to accumulate their money tax-free, not just tax-deferred. And then they want to be able to generate tax-free income to where when your money grows, let's say at an average of 9.6%, like I've averaged, 9.6% interest divided into the rule of 72 means your money will double about every 7.5 years. So I've had clients that started out, let's say, with 500,000 at one point in time, earning an average of 9.6. It doubled to $1 million in 7.5 years. And then they decided to start turning on income. And so that income at $1 million of cash value at 96,000 a year, which is 9.6, would allow them theoretically to pull out 96,000 a year, about 8,000 a month, totally tax-free. It's tax-free if they complied with TAMRA, the Technical and Miscellaneous Revenue Act, when they set up their IUL policy, which most people want to have tax-free access. And so if they started out with $500,000, you can't do that in one fell swoop, or else it'll only grow tax-deferred. Now, if you die, it will blossom and transfer tax-free. But if people want to turn on tax-free income, they can only fund an IUL policy generally over 5 years. So if you started out with $500,000, you had to put in only $100,000 a year for 5 years. And then you have your $500,000 in, and then that $500,000 can double to $1 million. $1 million doubles to $2 million. $2 million doubles to $4 million doubles to $8. We've had many clients do that, and some have $8 million now, and they started out with $500,000. Most of them did it in compliance with TAMRA because we do have a client right now that has $8 million that is generating between $600,000 to $800,000 a year of tax-free income. They don't even need that much to live on. But let's go back to what a MEC is. If you have a lump sum of money, let's say this $500,000, and you put it in one fell swoop and you maximum fund an IUL policy, and you're, let's say, age 60, the minimum amount of life insurance now is about double that. You put in $500,000 and you have to have $1 million of life insurance death benefit. Now, you could buy way more than $1 million of life insurance for $500,000. That's not the objective in this scenario. You're wanting the least amount of insurance the IRS will let you get away with. And so sometimes people say, Doug, I don't worry so much about the taxes if I access money, because I don't think I'm going to access money out of this. I want to maximize the growth, and I don't care if it's just tax deferred. And when I die, it's going to be tax free anyway. Yep. So we don't need to worry about that TAMRA law, do we? I go, no, not really. If you violate TAMRA, that's no big deal. Once the insurance company knows that's what you intended to do, even though you could grandfather yourself for tax-free income, it takes 5 years to get in your $500,000. If you put it in all in one fell swoop, it's going to grow tax deferred. It will probably still at, let's say, 9.6 double every 7.5 years tax deferred, but it won't be tax-free when you access it. And they say, you know what, we're fine with that. In fact, this is money that's just been sitting in the bank, and we're sick and tired of having money in a bank or a credit union rowing upstream, so to speak, at 1 mile an hour, 1% interest or less. And the current of inflation has been coming down at 3, 4, 5, and now inflation is 10, 12, and 15. We just want to increase the rate of return and keep up with inflation. I go, okay, I've got it. So you don't care if it's a MEC. Nope. What's a MEC? Modified endowment contract. You're simply giving up the tax-free access. You can access your money, but you'll have to pay tax on any of the money you withdraw, just like you would in a bank. In fact, a bank or credit union, it's taxed as earned. You have to pay tax whether you withdraw the money or not, because the bank's going to send you, an interest statement every year. That's taxed as earned. It's the worst way to save and the most common way Americans save. In a MEC policy, your money is tax deferred. You don't get a statement from the insurance company where you have to pay tax every year. But if you did access money, you would have to pay tax, just like an annuity or an IRA. But when you die, it will blossom $500,000. If you're age 60 and you took the minimum amount of life insurance required, you'd leave behind $1 million. You put in $500,000 and you die the next day, you leave behind $1 million totally tax-free. Show me anything else that does that. So when people come and they say, Doug, I'm just sick and tired of this money I have parked in a bank or credit union. I said, what's it earmarked for? And they said, well, in case of an emergency. Well, most people, if they really get honest with themselves, only need about 3 months, maybe up to 6 months of income in a bank or credit union with a drive-up window or whatever. When they realize they can access money out of an IUL policy with an electronic funds transfer, a phone call if push comes to shove, and in 48 hours, they realize maybe I don't need that drive-up window at the bank. That's just convenience. In today's day and age of electronics, we can access money out of an IUL policy in a matter of hours if we need to. So they realize it's liquid, it's safer. Most insurance companies are rated AA, AAA, whereas a lot of banks and credit unions are only rated BBB. So you're increasing the safety by sometimes 5 or 6 notches higher in safety, but the rate of return, even if you don't link to an index to where I've earned an average of 9.6%, if you just settle for the insurance company's general account portfolio rate of 4 or 5%, how much better is 4% tax-deferred interest in an insurance policy than 1% or less taxed as earned in a bank? So sometimes people just don't know what they don't know. And they realize, I'm fine if I just have, 40,000 or 50,000 in a bank for emergency purposes, but golly, why do I have 100 or 200 or 300,000 or $500,000 sitting in a bank? Well, I didn't know where else to put it, and I just haven't thought about it. And they don't realize how much they're losing because of inflation. They're rowing upstream at the rate of 1 mile an hour, and the current of inflation has been coming down double digits. And so they simply transfer the money, and they don't care about a MEC. You take the 100,000 or the 500,000, and you simply do a capital transfer out of the bank or the credit union into a life insurance policy once you get approved. And let's say you're age 60, and the minimum amount of life insurance is $1 million. You put 500,000 into the policy. That 500,000 now will grow tax deferred at just 4 or 5%, okay, instead of 1%. It will be tax deferred. And if you die, it blossoms and you leave behind twice as much. But if you want to maximize what you leave behind, I have stories on this channel that talk about how you can put in money into a MEC and take the greatest amount of life insurance, and you can end up leaving behind 4 or 5 times that. Where we had a client put in 300,000 and the amount of insurance was $1.5 million. He left behind $1.5 million tax-free when he died, instead of 500,000 in his IRAs, which only netted 300,000 after tax when the heirs get to inherit it and then have to pay tax. Does that make sense? So you need to focus on what it does more than what it is. So this is why a MEC can be far superior to having money in a bank or credit union if you want to increase the liquidity, the ability to access your money, the safety by several notches, the rate of return by 4 or 5 times or greater if you decide to apply the indexing strategy. And the tax benefits, even if you create a MEC, it's tax deferred, whereas money in a bank or credit union is taxed as earned. And so it's as good or better than an annuity or an IRA, and none of those blossom when you die. So I think it's by far the best way. It's a no-brainer in my opinion. So if this is intriguing you and you want to learn more about how to use a max-funded IUL for tax-free accumulation, access, and transferability, but if you don't care about the tax-free access, then just create a MEC and you increase the liquidity and the safety and the rate of return, and maybe the tax benefits are as good or maybe better because it blossoms and transfers tax-free than leaving the money in a bank or putting it in an annuity. So learn about this. I want to gift you a copy of my most recent best-selling book called The Laser Fund. This is how you can claim your free copy of this 300-page book. Simply go to laserfund.com or click on the link below, and you contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost, and I'll fire out a free copy to you. And then there's options there to listen and learn, watch and learn if you want. You can also check out some of our online educational virtual webinars that we do monthly, and you can even speak to an IUL specialist that will help you understand how you can implement this strategy. But this is actually 2 books in one. This side gives all the charts and graphs and explanations. You flip it over to this side, and this has 62 actual client stories of how to use a laser fund to achieve all kinds of financial goals, not just retirement, but emergency funds instead of having your money in some bank or credit union. So this is about you and your brighter future, and we'll see you on the other side of success.